welcome back to the course Introduction to Commercial Banking and Fintech. So, I have covered all the topics related to commercial banking and fintech. So, I thought it's a long course, it's 12 weeks course. So, some of you may have forgotten some of the concepts. So, what we are going to do is that in these two lectures, lectures 59 and 60, we will be going for some kind of an overview, or I would say a quick recap of all the things that we covered in a very summarized way, so that you can also reconnect with what we have covered so far, and also it will be a good summary of what we are going to what we have done so far in the course, and you can also see the wide coverage that I have tried to cover in this particular course and try to give you the exposure of different types of developments with regard to the banking sector and also the fintech. So, the idea behind this is that how we started, so overall design of the course, and also you can think of in terms of a good revision of the course, especially if you are preparing for or if you are appearing for exam. So, going with that idea, we can start. So, here the overview in terms of I have tried to summarize in one slide. So, what is the role of the banking sector? So, banking sector, the role of we also call it banking as financial intermediary. Why intermediary? Because it comes between borrower and it comes between lender and borrower. So, if you have money and if you are depositing money in the bank, so bank accepts your money as deposit and keep certain amount of your deposit as fraction, which is like compliance for the bank to keep that, and rest of the amount it disburses as a loan to some borrowers. Now, in this whole process, the idea is that when bank is going to accept your deposit, so it gives you some rate of interest on that, but when it gives money to the borrower, it charges from them. Right? So, the idea behind this is that the intermediation which is happening, whether it is profitable or unprofitable, which means that if the bank is not able to generate enough money which it is paying on the deposits, then for the bank it will be a big business trouble. And this is where the whole idea of commercial banking starts, with complications with regard to the regulations and also with regard to the functioning. So, in this particular course, we started with the foundations of banking and financial intermediation, that how it happens, what are the types of banks in India, how we have started developing it, what are the instruments to measure the money supply and also put a check on the banking sector liquidity and overall intermediation process. Then we went into the micro foundations of the banking sector, and in that we covered the balance sheet indicators, both income and financial statements, and also we went for some of the indicators related to risk management. In risk management, we explicitly covered the dimensions of banking sector regulation with different set of norms that we have seen evolving globally. So, we saw Basel I, Basel II, Basel III post 2007-8 global financial crisis, and also we saw major indicators related to Basel III disclosure. So, those angles were part of. Then related to the first, which is about the foundations of banking and financial intermediation. So, for example, if I am talking about this, so this is where it comes. So, here we have the credit creation. What is the credit creation? So, it talks about the fractional banking that we covered. So, in fractional banking, we call it as fractional reserve banking, whether it is SBI or any bank you consider. So, fractional reserve banking is one area that we know in modern banking. This is what we call it as the fraction, because you deposit certain amount, for example, rupees 100. If it is 10% your reserve requirement set by the government or the central bank, then the bank is going to have 90 rupees, because 10% of this will be reserve. 90 rupees they can lend. So, which means that bank can earn the rate of interest on 90 rupees and pay a rate of interest on 100 rupees, right. So which means that in order to make money, bank will be offering less rate of interest on 100 rupees and charging more from rupees 90, and this is where the fractional ledger banking comes in. One of the important dimensions of fractional ledger banking is the credit creation, that if I keep money in the one bank, and from that bank if I borrow some money and keep in some other bank where I have the account, then the reserve requirement set by the central bank will be applicable on each deposit that I am going to keep or move from one bank to another. And this fractional ledger movement from one bank to another based on the received deposit is called, the name we call it as credit creation. Then comes the regulation, that different types of regulations are there. For example, asset quality review based regulations. The Basel one, we mentioned about the capital adequacy ratio. What happens when the bank is going to see a bank run case? Then in that case, we calculated these ratios, the CAR, and then we had also gone for common equity tier 1, additional tier 1 capital. Then we also went for understanding the tier 2 capital. Then we also saw some of the provisions for loan losses which banks have to, subordinated debt and other stuff. So basically it deals with the systemic risk, because in order to avoid systemic risk, banks are supposed to keep certain amount of money as a regulation part. And then why we are doing it? Because we have to avoid the financial stability. And in financial stability, we talked about different measures of what we call it as the systemic risk. Right. So this angle is very, very important. Then we also touched upon the fintech system, which talked about the digital banking, and we found that with the ease of digital, I would say in India we call it as digital public infrastructure, DPI. So with the ease of availability of digital footprint, what we learned that certain institutions or some companies using that digital footprint and offering the banking services at fractional cost. So fractional ledger banking to fractional cost banking, we discussed different dimensions of the fintech and digital banking, including open banking that we saw in the case of UK, that how UK is promoting that the open banking wherein the companies can access through APIs, right? So if I am going to borrow from the bank, then a bank will have the access of my credit history through API, and they'll be using that. But there are angles attached to it. For example, you have the cyber security related issues where the challenge is actually very, very important, because a lot of time we have experienced that the majority of the population is not very enthusiastic, because they don't see that much strong, I would say, strong safety nets for any cyber fraud. So this is where towards the end we also discussed some of the important directions in banking and finance, that what it could be. So overall, if I have to summarize, so we started with intermediation process, that how banks go for intermediation. Then we went for risk management. Then we went for regulation, and then we finally looked at the innovation. Innovation basically implies here the fintech that we talked about. So how fintech startups have helped a lot in building up the innovation capabilities and providing services at a very cheap rate. Now in a more formal setup, if we have to understand why do banks exist, so because they are intermediary, so they have to be between savers and borrowers. But the idea behind the saver and borrowers is not easy, because a lot of time it happens that banks incur higher defaults, and as a result, if it is unbearable, then banks go for liquidation, and it becomes really, really important. So information asymmetry between lenders and borrowers. So which means that if I am the borrower and I went to a bank to borrow money, bank asks for KYC, and I somewhere hide some details which bank should know. So material information I do not share with the bank, and as a result what happens that I end up getting loans, but after that if I don't pay on time to the bank, or I don't go for service payments, then it creates a big trouble for the bank. So a lot of time when we were discussing about lenders and borrowers, so at that time we also discussed about we had something called good borrower and bad borrower. So if you have a good borrower, bank, even if they have not done proper due diligence, they will not experience uh, awkward moment because they have the good history of repayment, so they will pay anyway. But the agency problem starts when we have the bad borrowers present in the economy. And that's why when we were discussing this topic, then we discussed that why banks charge higher rate of interest when you borrow, and then when you deposit they offer you a less rate of interest. This is partly because of the presence of this bad borrower. They charge something called default premium, right? So this we discussed in theory. We also mentioned the book of Williamson to discuss that how profitability of bank changes. So if you have like a good number of bad borrowers, then the default premium will go up. So you bank will charge higher rate of interest. As a result, what happens that there will be crowding out of good borrowers also. So credible borrowers will also experience the same high rate of interest. So that is the unfairness that we see. Sometime whenever we have high uncertainty in the market, banks tend to decline even the request of the good borrower, which is somewhat concerning, and this is where we see information asymmetry playing an important role. Especially the monitoring and screening cost becomes important. So we also saw that the default premium plus monitoring and screening cost bank charge. So when you go and borrow money from the bank, they also charge some amount as a processing fee because partly they have to maintain the file. They also have to deploy one person who will be looking after it. So it becomes important. Monitoring and screening cost, we discussed that in case of fintech, it becomes much more economical, and we found that the cost of easing or cost of easing in terms of facilitation of services becomes very important in this, and this is where we found that the monitoring screening cost in case of fintech, it becomes almost zero. So they provide on a larger scale, and they can also go for example, we had gone for discussing eKYC. So if you are going for manual KYC, normal account opening takes 1 week. If you are going for eKYC, then it basically helps in facilitation of services. So in minutes the account will open. So a lot of time we see that. So compared to conventional banking, which depend upon the mostly the manual exercise, in that monitoring and screening cost was higher, and then we saw that with fintech application it becomes much more affordable and viable. Liquidity needs of depositors. So we can link this with the Diamond and Divig model of bank run. What happened that if the depositor is going to keep certain amount of money, the depositor is entitled to withdraw money at any point of time. So that's why we call it a demand deposits. And why demand deposits? Because on demand the depositor can ask for deposited money, bank cannot say no. But the liquidity needs of the depositor important, because if there is a higher amount of deposit withdrawals, then the bank will have a real difficulty, because if they are not getting enough return from the asset and you have the higher withdrawal or deposits, then bank will be in deep trouble, and they may put a cap on withdrawal. So that we saw in the Diamond Divig model, that when a shock occurs and when people are so much bothered about that shock, then it may happen that there will be customers who will not be looking for long term deposits and they will be going for early withdrawal. So the bank, what happens that when everyone goes for early withdrawal, then whatever is the left out asset, it is left to those who did not go to withdrawal at the early stage. So what is going to happen? Now the bank health has deteriorated already. So what is going to happen that when they sell the asset, they will be selling at discount. So suppose they had 200 crore worth of the asset left after withdrawal from everyone. Now those people who were still interested in keeping their deposits for the long term, so what happens that they will be so bank will be getting, for example, 200 crore of asset being sold in the market. The market is giving just 110 crore. It means that now even if their deposit size is 180 crore of these people, those who were having still faith in the bank, they will have to settle with 110 crore, and 70 crore rupees will be the collateral loss because they did not react on time. So that's why we see that whenever panic occurs, you will find that the central bank and regulator comes in and they try to build up the confidence. Recently we saw with the HDFC Bank that how it is happening. How it is happening that when the news came that certain ethical standards are there, issues are there with the HDFC operations, then the central bank came in and they had given the proper communication. So there is a role of proper communication too. We discuss about the communication with regard to conventional and unconventional, right? So we had the forward guidance and all those angles. So this is where the idea comes in, risk pooling and diversification, in the sense that how we can go about the income diversification. Like for example, we saw in case of CAR, we had the risk weighted assets. So risk weighted assets, what is the meaning of risk weighted asset? That here we can go on building up of different type of assets. So earlier we were in more in mortgage, or maybe in terms of auto loans, or maybe in corporate lending, household. So we can readjust. So this is where it becomes important. Risk pooling, why it is important? Because we can think about that if you have a shock occurring, whatever is the magnitude of the loss, if it can be pulled from different sources, then it becomes important. So risk pooling and diverse. So there will be deployment of CET1, then AT1, and then tier 2. So what is the most important part? That banks help in capital allocation. At the same time, they also help in liquidity transmission. So this is where it is very, very important to look at. Then the commercial bank in the financial system. So this we have already we have already focused on, which means that we have the depositors, banks and borrowers playing an important role. So we already covered this. Then comes the bank balance sheet. We are going at the individual bank level. So I reminded this at that time when we were discussing the bank balance sheet, but I am reminding it again that there is a huge difference between the non-financial firm balance sheet and the financial firm balance sheet, because the income streams are different. For example, Tata Motors is producing motors, or you can say vehicles, and they sell. It is in physical form, whereas a bank will be earning their income based on the rate of interest. So the source of earning is not clearly visible. So in terms of sales revenue, others, the indicators will be different. So when we go for examining the financial firm and non-financial firm, so we have to be very clear, especially with regard to the mostly with the balance sheet indicators. It becomes important that how we can go about it. So you have to maintain the parity. Total asset of this side or total asset of that side will be different for financial and non-financial firms. So this is where it is so important to note. So one is the asset. So in asset we mentioned about the loans first, then we have the investment in security second, then we have the cash reserves and interbank claims. These are the asset, which means that bank can go for the non-interest income, right? So this is what we say. So we can easily write. So we call it as the non-interest income. So this is what we get in investment in securities. Cash and reserves, which banks are having. For example, when they receive deposit, certain amount of money they keep as a cash and some amount. So this reserves that we are seeing, we saw that in terms of excess reserves, right? So we have the excess reserves, right? So this is what here we have. Then here the interbank claims that we think about. So this is what we find here, that how so interbank, which means that they have gone for borrowing and lending at, we have something called call money rate. So this we did it, right? We call it as CMR. So this is overnight borrowing and lending happening. It is offered at much higher rate than the call money rate, and this is where it becomes important. And then in liabilities, here we have demand and time deposits, borrowings if they have done, other liabilities means deferred tax, dividend undue, so the dividend due. So those things are included in other liabilities. And in capital, they have something, if it is listed, they will have the equity and market capitalization. And retained earnings, if they have not gone for dividend declaration, then that amount they can use that for as retained earnings, and use that for making investment or introducing new products. So which means that if you are going for the capital, so capital is your asset is nothing but liabilities plus capital, and your capital is nothing but asset minus liability. So this is what we get here. And so in terms of when we discussing the balance sheet, we also focused on different sources of income of a bank. So what were sources? So in terms of bank profitability, one important dimension that we looked was the interest earned on loans and investments, interest paid on deposits and borrowings, and fee based income for payments like cards, distribution, advisory services they provide. Then other they had the operating cost. So in order to run a branch per day basis, bank calculates that how much they are incurring costs. So all the employees, the lighting, in the furnitures and locker services, whatever they have on in the, I would say, premise, they calculate that a monthly basis. If a branch running cost is like 10 lakh rupees per month, and if they are not able to get even the deposits by 10 lakh, then it will be a big loss for the bank, and they may be thinking about closing that branch. So this operating cost is very important. In terms of payments and card, if they are offering, for example, if they are offering debit card, then it becomes easier. But if they are having credit card, which means that in advance they are committing for the certain amount of money to the card holder, then the monitoring becomes important. And there you can think in terms of intertemporal terms, that if the people are having a higher amount of card ownership, then it becomes really a good amount of cost incurred by the bank in maintaining those records of the transactions, and also making sure that the defaults have, if it has happened, then they're able to recover the money. So this is where it is very important. So if you think about profit of the bank, so it is having the interest income, non-interest income, minus interest expense, and minus operating cost, minus provisioning. Provisioning is related to NPAs. If the bank does not receive any amount of money on the outstanding loan up to 90 days, then it is qualified as NPAs, and then they go for doubtful and other characteristics. Before that, there is early warning monitoring. So for example, they can go for SMA 0, 1 to 30 days, SMA 1, SMA 2, 30 to 60, 60 to 90, and then they can think about whether they have the chance of getting money back or not. Then we went for calculating spreads. So the first spread was between the net interest margin. So spread was how much they are getting on loan and how much they are paying on deposit. So this is what. So RL is the rate of interest offered on loan. So which means that is the income of the bank. Rate of interest given on the deposits. When depositors are keeping money with you, then that is called RD. So this has to be this spread is the gain for the bank. If the spread is larger, banks is making more money, and if the spread is lower, it means that bank is really working on a tight floor or corridor. So net interest margin, here we have interest income minus interest expense upon earning assets. So this is what a higher net interest margin improves profitability, but very high lending rates may increase default risk and reduce credit demand. So this is what we find about. Then we also touched upon some of the macro aspects of the commercial banking, and we mentioned that in credit creation, in terms of reserve requirement, it plays a very important role. And there we found that if the reserve requirement, so we found that if we have 1 upon C plus RR plus ER, so which means that if we have cash being kept, so if I'm keeping, I withdraw money from the bank in hard cash and I'm keeping my in my pocket, then it will not have any kind of impact on the money supply. So this has to be lower. So if it is 0 and excess reserves with the central bank, that the money that banks keep, so if it is 0, it means that you are partly, because this RR is nothing but it is decided by the central bank. So normally it is called CRR and plus SLR. So if reserve ratio is lower, then it means that banks have higher amount of money for lending, so money multiplier will be higher. So this lower will be having the good impact. If it is higher, the overall money multiplier will be lower. So this we discussed, which means that the role of the central bank is very crucial. For example, in case of India, the RBI plays a very important role, and this is partly because this is reserve requirement which banks have to maintain. So this is like suitable for the bank. irrespective of whether it is government, private, scheduled, non-scheduled. Whereas ER, it means that if ER is 0, it means that bank, whatever they are receiving deposit, after keeping the RR, rest of the amount they are able to disburse as a loan. So it is a good calculation. Whereas C, we mentioned that it is a leakage. It is also a leakage. It means that banks have extra money to keep in the bank. They are not able to lend, and this is not a good business that they have to. Then another is that banks go for liquid transformation, which means that they also go for, sometimes they fund the long term projects. So for that they may be borrowing at short term, and they may be thinking that the short term rates, at the short term rates they may be funding at long term financing. So in that case the maturity and withdrawability, safety plays important role. So this we discussed when we are talking about NPAs, that how NPAs are important. And then we also touched upon information asymmetry. So this we discussed already, that when the risky borrowers are more willing to borrow, and when borrower take more risk after taking the loan from the bank. So these are the cases that we already discussed, agency theory. Then we also touch upon in Basel II, we calculated credit risk and expected loss. So expected loss was PD into LGD into EAD. So probability default that we calculate through the regression approach based on the KYC formula, KYC details. Then here we have the loss given default, which means that how much bank incurred the loss after the default, which means that if suppose I took a car loan and I have defaulted on it, and bank sells the car in the second hand market, whatever is the outstanding amount of default and whatever they get after selling the car, the difference is called LGD. So loss given default. Exposure at default, that when I defaulted, though the car loan amount was 8 lakh, when I defaulted the outstanding amount was 6 lakhs. So exposure at default will be 6 lakhs, and if suppose bank is able to sell the car at 4 lakh rupees, so 2 lakh rupees is the LGD. We call it a loss given default. So expected loss for the bank depends upon probability default, loss given default, and exposure at default, and this plays a very, very important role to understand. Then we also discussed the asset quality and NPAs, that how NPAs play important role. So here we say that if the loan amount is without any payment for up to 90 days, then it becomes NPA, and it is bound to have the impact, and banks declare. But the important characteristic of NPAs is that it reduces the income of the bank, because it will be there on the balance sheet, and bank will have to go for provisioning, and provisioning becomes important, and this for further creates the trouble. So for that, central bank launched the early warning, early monitoring system, and which we call it as SMA, SMA 0, SMA 1, SMA 2, and this is where it is very, very important. Then here we have the capital adequacy, and in Basel I we mentioned that once we have the capital adequacy, which means the total capital tier 1 and tier 2 plus AT1 upon the risk weighted the exposure of the loan into different sectors. So if it is overall, if CAR, if the capital is higher, your CAR will be higher. So normally 12 to 15% is the criteria. So we also saw that why capital adequacy becomes, what is the logic behind the capital adequacy becomes so important, because it is directly dealing with the how much cushioning a bank has. It means that how much it has the common equity tier 1, additional tier 1, and then the common equity tier 2. So these are the important dimensions that we look at. So observe shocks from credit, market, and operational losses that we do it. Now here we have the liquidity regulation. So liquidity regulation implies that how we are becoming important from the central bank and bank supervision, which means that whether the banks are, so I have also mentioned that whether when they hold enough high liquid asset to survive short term stress, which means that whether if suppose they have the common equity tier 1 of 1000 crore, and with some shock they incur the loss of 200 crore, then it will be easier for the bank to observe that shock. So this is what high quality liquid assets to survive short term stress, which means that they have higher cash in their hand, and this ensures the funding structure. So in case of IL&FS, we saw that this was the important characteristics. And then we also touched upon the interest rate risk and duration. We were discussing the monetary policy transmission, so it is linked with the asset liability management and how duration of securities matter. In case of operation twist, we also saw that how the short term and long term yield curves are changed by the central bank decisions to pump money in the short term or the long term based on the scenario that they look at. So with this, I hope you have been able to recall the topics that we discuss, and with that idea I try to mention most of the topics that I touch. I may have forgotten one or two topics, not in detail, but I hope with this revision you are able to recall some of the topics that we discussed long back with when we were having the discussion on monetary policy and credit creation and other. So with this I am stopping it here. Thank you so much. In the next section I will complete rest of the topics. Thanks a lot.